Hey everyone, Angie Harness here from Keller Williams. And hey, guess what today is, guys? It's Red Day. And red, just so you know, stands for renew, energize, and donate. And I'll get back on a little bit later to tell you all about that and tell you how you can participate. But today I want to introduce you to Wil Glidewell with Central Bank. And Wil and I met on Zoom a few weeks ago, and he has some really interesting programs that are unique to Central Bank. And I wanted to come on and share that information with you. And we're going to just talk about a little bit about what's going on in the real estate industry and in the market, and just share a little bit of our take on what we think is happening and what we think is going to continue to happen. So without further ado, Wil Glidewell.
Hey, Angie, how are you?
I'm good. How are you, Wil?
Doing great, thank you.
Awesome. So tell everybody a little bit about yourself, and let's talk about some of those programs that are pretty cool and unique.
Yeah. I probably aged myself. I actually have been in the mortgage business now for 30 years. A lot of that time was spent managing other loan officers. And a couple of years ago, I felt that there was such an opportunity missing in the industry to serve borrowers with information that I don't think they were getting from other lenders. As well as just serve realtors in a way that I don't think they were really served very well. And so it's been a great ride, and I really enjoy the information and just the service that I feel like I can give to a customer. So very excited to have some time with you today and share with your audience.
So what are some of those gaps you think that we're missing and that you feel you have helped to cover?
Yeah, so a lot of it's information. Other things that I think are missing are just programs. So, every market is unique, and I never have seen a market like this, and I'm sure you haven't either. But it just brings unique challenges, and a lot of this is just information and how to structure transactions that make it work. That make it work in a lot of different ways, from monthly payments that are comfortable for a borrower when you have sometimes offers that are have to be made, $20,000, $30,000, $40,000 over asking price. How does that affect the down payment? Most lenders will just tell the buyer that, well, if it's $30,000 over appraised value, you pay an extra $30,000, and it's not necessarily the case at all. You can keep the payments, you can keep the down payment relatively the same. I mean, compared to where you start. And so there's just a lot of misinformation, and I think that you and I talked a lot about the perception of what happens when or if 2008 comes again. And while there's some similarities, I think there's a lot of differences. But even if you take those numbers and apply them today, going forward, still homeownership makes so much more sense than the alternative. And so I think it's a great foundation to build. I say wealth, but it's also a home. It's a home that you can raise your family, and gosh, you just can't put a value on that. It's just I'm excited to be part of that. The other part is just some of the obstacles are down payment, and so really proud to work with Central Bank because we offer some outstanding programs. One, we have a down payment assistance program that is it has to be within the footprint of the bank, but it can lend. When I say lend, it's actually a grant. It's a gift for down payment or closing costs. There's certain income limitations to that, but also we have some professional loans. What I mean by that is based upon the homeowners or the buyer's profession, such as first responders, teachers, nurses, medical professionals that really can come in with no down payment. And so I always kind of laugh because one of the arguments against a reoccurrence of 2008 is the no money down loans. And there are a lot of differences. Back then, I was in the industry. Those loans were done regardless of credit score, regardless of qualifying them with income. It's no income documentation, bad credit. The only thing they had to hang their hat on is they assumed that values were going up. In today's world, you have to have money in reserves, even though you may put no money down. You have to have a good history of making your payments on time, of employment. So there's a lot of other things that come into play that I don't think are all reflective of of 2008. And even still, buying a home is a long-term, I hate words play, but you really have to look at it over the long term. And even applying numbers, and I can share these with you later, numbers from 2008, you're still so much better off than even just renting, for example.
Absolutely. You can pay your own mortgage or someone else's. And so if you pay
Exactly.
your
Yeah.
own mortgage, if you pay your own mortgage, then you have something that you are investing in. And even if home values level out, you still have an investment versus if you're renting, you have absolutely nothing. And I would
Yeah.
add, you talked about the difference between now and 2008. There's a big difference between someone who's a paramedic or a teacher or a police officer who have steady jobs that aren't going to, barring something, them doing something weird, aren't going anywhere, having no money down, than someone who does not have steady income that they can prove having no money down. Those are two huge differences.
Yeah, very, very much so. Yeah, yeah. And again, there was just a lot of speculation. Truly, the interest rates on those loans were of such where it was just made them difficult to qualify or to pay, but no one cared. And that's just a really big difference, I think, in that. So I think one of the primary differences, too, is sometimes homeowners or home buyers, they look at it the short term, and they really need to look at over the long term, because that's the most important. When I say they need to look at it, meaning the way you structure a loan, the way you structure an offer. Yes, what short term is important, but over the long term can make a huge, huge difference. And again, I think in this market, where I think the struggles are, yes, there's a low inventory, but from a lender's perspective, from an agent's perspective, a big part of that is giving a buyer confidence that they can make this work, giving them the confidence that it makes sense to move forward if that is an offer that has to be made over purchase price or over appraised value. And then on the listing side, it's part of making the listing agent confident that your buyer is going to go forward with the transaction that will qualify. So obviously purchase price is important. The seller always wants to get as much out of that as possible, but with all things equal, you can attest to this as a listing agent. You're going to pick the one that isn't going to fall through.
Absolutely.
And so having a buyer who's confident and we can demonstrate that they've taken consideration all situations, I think it gives that listing agent some confidence, and I think who they go with as a lender also is important too. I had this national mastermind group, and they were talking about nationwide lenders and just the nightmares. I mean, there were like 500 responses to this.
It's horrible.
And so, yeah.
It's horrible,
and
especially when their underwriters are out of state and don't know how it works in our state.
Exactly. Yes. I mean, I've seen, sending Kentucky disclosures to a buyer in Missouri. And, the scariest thing I feel, and I take this very, very serious, as a homeowner or a home buyer, your entire life is on a moving truck. And when you have these national lenders, sometimes the money doesn't show up and you don't have a place to go because they're scrambling at the last minute. So it's just important to work with someone local, someone you can look at in the eye, and the money's going to be there when it comes to close, and all the I's are dotted and the T's are crossed long before that closing occurs. So
yeah, it makes a huge difference. I will tell you that as a listing agent, when I am getting offers and looking at pre-approvals, I'm looking over them very carefully. I'm looking to see who the lender is. Oftentimes I'm calling that lender just to have a conversation and say, okay, scale of 1 to 10, how good is this buyer? And then the other thing you mentioned, in a multiple offer situation, a perfect example of what you were talking about is I have a listing where we had multiple offers, and one of them, the purchase price that they were offering was the highest purchase price. However, it was a FHA loan, so they didn't have the option of dropping the appraisal. The other offers were not as big of a number, very good number, but they were dropping the appraisal. One of them was willing to drop the appraisal and the inspection. So guess that's the one that won. So that buyer, and I made sure that buyer has the money. And so that buyer, is going to pay that dollar amount no matter what the house appraises at.
Absolutely.
So
Yeah.
that makes a big difference in your loan product if you're able to do those things.
Absolutely. Yeah. Let me, I'm curious. I'd love to share with you something that I think are important. It would be important to a buyer along that lines of dropping the appraised value or the appraisal writer, because that brings a little bit of unknown there. What happens? I mean, am I going to be able to come up with the difference? Am I going to be able to afford the payments? And so, not every scenario is the same, but let's see. Yeah, there we go. So let me just give you a quick scenario here. And I know we got a question about first-time home buyers, and we'll get to that as well here. So let's just say a $330,000 purchase price. This actually happened to be a live scenario for me. And they were looking to purchase the home for 360, so 30,000 above. So they were putting 20% down. And this was, gosh, a month old. So rates have come down a little bit, but it's a great apples to apples comparison here. With a 20% down payment and the rate as it was back then, they would have come in with about $79,000 and their payment would be just shy of $1,800. So question is, what if the appraisal came in lower? Again, most lenders will look at this and say, well, you have to come $20,000 additional out of pocket. They didn't have a $20,000. So it's easy to structure this in a little different way that not only impacts or doesn't impact their monthly payment, but not impact their cash to close as well. Because typically, if you're raising the loan amount 20,000, it's going to increase the payment considerably. But if it's structured properly, and I had 30 years experience when I first looked at this, it took me 20 minutes to figure this out. And it's not rocket science. It's just how you structure the loan. So in this case, with a $20,000, let's say again, this is priced for $340,000, their offers $360,000, they can still maintain an $1,800 payment and the cash to close of $79,000. So exact same thing. If you move over to $30,000 under their asking price, the contract price, again, you can still structure this where the dollar amount for the payment is only $4.29 more. And then the cash to close is still $79,808, still within $700. So it just requires someone to look outside the box. And so that's kind of the short term. And I mentioned earlier, long term. And so if you look at these scenarios here, I mean, the interest over the next few years is very little. And I'm going to get back to this last scenario here in just a second. But the appreciation, even if they purchase the home under appraised value over the next 12 years, and this is using the same appreciation rate from 2007, so prior to the crash, to 2019, you're still looking at, with even a $30,000 under appraised value or over your purchase price, 30,000 over appraised value, you still have $209,000 in equity, the worst case scenario. So yes, it's important to look back at history, but you also have to look forward and assume that both worst case scenario and best case scenario. I mean, worst case scenario, you probably shouldn't rent an apartment either, because that also can put you out on the street. So, but applying a worst case scenario, it still makes sense to become a homeowner. And in this case here, I also hear one of the questions this buyer had was, well, why don't I wait for a year? Let's wait for the market to settle down. So, well, I wanted to give them an answer on that. So let me go back here. Oh, there we go. So I added a fourth scenario, and somewhat speculative, but let's just say the appreciation rate that's currently in place is cut in half over the next 12 months. And also good chance rates are going up because inflation's there. And again, this is only a 5/8 increase in rate. What happens if that house appreciates and the interest rates go up? So, well, that $360,000 home is now $376,000 with rates at 3.75. Their payment would go up by $177, and their cash to close would go up by $3,000 as well. So there's really little benefit to waiting. One of the greatest costs of ownership is the interest rate, and we don't know what's going to happen, but rates are very low right now. And I do believe that we'll probably see some increase in rates within the next 6 months. Still very low, but it will probably be higher than it is today. So that's just information that I think a client should know and be aware of. It's not that I'm advocating that you pay over $30,000, but if you want a home in today's market, it may be what's required to do that. And no one should go without having at least the right information in hand. So hope that's helpful. And then I know there's a question out there about first-time homebuyers. Yes, absolutely. There is definitely first-time homebuyer programs out there, somewhat income driven, but yes, some programs out there for qualified buyers, and every one of these is qualified borrowers with no money down or assistance for down payment and closing costs.
Absolutely.
Great question.
And on top of that too, and this isn't, you don't have to be a first-time home buyer. We still have our rural areas where you can get a USDA loan, which is 100% financing.
Absolutely.
So but you got to go in the rural, so we're like Wright City, Warrenton, Moscow Mills, Troy area, out in some outlier areas of Jefferson County and Franklin County as well. So if you're willing to drive a little bit, you can get in on some of those, that USDA program as well, which can be a really good program for some folks.
Absolutely. Yeah. And again, it doesn't necessarily have to be a first-time home buyer, but our program, our subsidy is $2,500. Most cases it's applied towards closing costs. And, time and time again, I always share this with clients because I think they forget, gift money is allowed. So relatives could gift, you could get into a conventional loan, great rate, 3% down. That money can be gifted from a relative. If you qualify for the $2,500 subsidy, that covers a good portion of the closing cost, and you have a little bit of your escrows available or needed. And so you can still get a home for very little money.
And that is such a big deal, Will, because being able to coming up with those closing costs, which are usually anywhere from $4,000 to $6,000 on average. For some folks, I mean, if you're raising kids and you're doing all those things, trying to save that amount of money can be a bit of a challenge because, you might be living a little bit paycheck to paycheck. However, you also might be paying, $1,500 a month in rent, which could very easily put you in a nice home for the same amount of monthly payment. So having those programs that help people kind of get that little bit of a start is really fantastic.
Yeah. Interesting. I didn't include this, but this home buyer that I just shared was renting. And if you recall back where in 12 years they would have equity of $280,000. I also had a rent analysis alongside that, and their net worth renting would be basically a little bit higher than the $95,000 they had saved because they had it just all in bank and really little interest. So $90,000 to $280,000 in that same period of time. And the payments, when you take in consideration the equity or the principal part of that, was really very, very little. There was very little difference between the two. So homeownership just makes so much sense. And it's not for everyone, but in most cases it is, again, emotionally and financially, just a great choice.
100%. Well, it's statistically true that people who own a home build more wealth over the lifetime than people who don't. So it's a great investment. And everybody has to start somewhere. I have some clients right now, we've got them under contract for a home in Hawk Point. We were able to find them a home that well within their budget. And, they're just getting started and they're expecting their first child, and it's going to be a great start for them. And their monthly payment is going to be right around where they're paying in rent right now. So it's super affordable for them.
Absolutely.
And now they're going to start building their wealth, which is a wonderful, wonderful thing.
I think so too. Yeah. I used to work in corporate relocation. And so they had just tons of statistics out there, and just the value of home ownership. They were looking at from an employer's perspective, the value of having an employee who is a homeowner was so much better than having one rent. Obviously stability, but just more productive. And so it just really carries out, I think, throughout your entire life and everything that you do.
Yeah, there's something very special. It's a big cornerstone. It's a cornerstone of our economy. It's also a cornerstone of our country. You know, that back when this country was founded, people owning their own property, that, you know, back in the old days was not a thing.
Absolutely. Yeah. And also one other thing that we talked about last time, which I think is a challenge, you have challenges of getting the down payment, but likewise, you have move up buyers who are struggling to get a home because they have a house to sell. And it just kind of prompted that same problem, but different scenario. And so there's a lot of creative ways to do this as well. I mean, it doesn't work for every homeowner, but again, I think you have to look at it over the long term. So, there's always that idea that you want to put 20% down. And I encourage that. I think it's a great way to set it up. But if you don't have the equity from the sale of your house to put 20% down, there's ways of structuring your initial loan to put a minimal down payment. And not every lender offers this, but there is something called a recast. So what that means, let me just back up a little bit. So typically, if you want to put a big chunk of money down on a loan, you can do so and it will save you interest, but it won't change your payment. It's still going to be based upon the original loan. And under that scenario, selling your house later and applying the equity doesn't do a lot of benefit or provide a lot of benefit. Whereas, let's say, for example, you put 5% down on your new home, your house that you currently live in sells later, you take that equity and you apply it and you implement what's called a recast. When you request that recast, your payment will now reflect your new payment. And the mortgage insurance also drops off. So there's just a great benefit to that. So there's different ways of structuring that. There is our bridge loans that you can borrow the equity. You can do home equity loans, but if this recast is appropriate, it is just a great way and probably the least expensive ways of structuring that that's out there. And so because not everyone offers it, not everyone's available, but this is a great option.
Yes, we talked about that, and I think that is a fantastic scenario. And really, and correct me if I'm wrong, but that is it's really for people who can make two payments at the
That's
same time.
correct.
They can absorb that if they still owe money on their existing home.
Yes, that's correct. Yeah. And there's some possible changes that are coming to the mortgage industry. There was a patch where back, I think it was 2008 or after 2008, that you could not have a debt to income ratio above 43%. And there was what's called a patch that was put on that if automated underwriting said that debt to income ratio was higher, you could go ahead and do that loan. In the case of this recast, it's very possible that some homeowners or home buyers in that scenario will be affected by it if it goes into play. Where I think that it's important which is why I enjoy working where I'm at, is we have portfolio options that we could structure it a non-Fannie, non-Freddie loan, more of a short-term scenario to get them through what is really important, which is getting that house. There's nothing more frustrating, I'm sure. I feel so bad for agents sometimes where a home buyer finds the house of their dreams and they just can't buy it for whatever reason. And so it's just very satisfactory to at least be able to offer options that may help them get that house that they really just dream of. So.
Absolutely. Well, and so that's one of the things we need to do our job as realtors and making sure that client has spoken with someone like yourself to really have a very good handle on not only what they can afford reasonably and also what they're actually comfortable with. Because a lot, what I find is a lot of times my buyer clients, they might be able to technically afford something. However, their comfort level, they might be able to afford here, but their comfort level is more here. And so we have to make sure we have those conversations and really honor where they are. Can you explain a little bit? I think a lot of people don't maybe know what a portfolio loan is. So can you explain that a little bit?
Yeah, I need to probably take a step back and explain a little bit more about Fannie, Freddie, FHA, which we've all heard of. But if you go back even further, it used to be a situation where you go to your bank would take money that is in deposits and lend it to anyone who's wanting to buy a home. And it's very much along that lines of supply and demand. There's only so much deposit that a bank can lend. So Fannie and Freddie came along and said, if you underwrite the file with these guidelines, we will replenish your funds. And that made funds money more available. And that's what really drastically pulled the interest rate down. We as a bank, we continue to service the loans. You still make your payments to central bank. We could also shop the loans for a better rate if that's possible as well. But almost all loans are sold to Fannie Mae and Freddie Mac, and we have to follow their guidelines, not just us, but every lender, or FHA or VA or USDA. They establish the guidelines, and they're the ones coming out and saying we can't have debt to income ratios exceeding 43%. However, as a bank, as a lending institution, we can do portfolio loans, which means it's money that we don't plan to sell to Fannie and Freddie. That's a portfolio loan. It's our money. We will keep retaining the servicing of it. And therefore, we have a little more flexibility when it comes to certain things. There's still an obligation to make sure that the buyer is qualified. But it does give us a lot of flexibility, like the 100% financing. That's not something that would work through Fannie or Freddie, but it's a program that for the right buyers, we feel, is important to make available.
That's awesome. So in a portfolio situation, I know that like oftentimes doctors are clients for those. Who else are usually maybe some of your folks who might benefit from a portfolio loan?
Yeah, so it's a great question. So sometimes it's just scenarios that are outside the box. It just doesn't fit in that Fannie, but they're still a good buyer. Great credit score, a lot of assets that, they continue to make the payments. I think what comes to mind sometimes are non-warrantable condominiums or just something that, maybe it's just short term. For example, if that patch goes away and a home buyer wants to qualify for 2 mortgages for just a month or two, that's something that we could use our portfolio program for. Other scenarios, again, you mentioned doctors. They're great, particularly for the residency. They're not making great money right now. They may have a lot of student debt, but their income potential is just enormous. So we have 100% financing programs in those scenarios, but it's not only just for those, but as I mentioned earlier, your first responders, your fire, your police, your EMT, your nurses. And then we also have just what we call a professional loan. And that's anyone with like a college degree that has a state license. So CPAs, those types of scenarios that also have some available financing. So one of the things that's a little unique, and I think that, when it comes to looking at something responsible or irresponsible, those loans are typically a first mortgage of 80% and a second mortgage of 20%. And that second mortgage is amortized over 20 years. And that allows equity to be built up much faster than just a simple 30-year fixed. So to me, it just brings a little bit of responsibility to the scenario.
Yeah. Well, Wil, you clearly know your stuff. That's for sure.
Well, it's interesting. I really had an opportunity to choose a lender, when I decided to go out on my own. And it was just important to me that I look at it from the perspective of a home buyer and a real estate agent, and how can I best serve them? And, not everyone has the same scenarios. And so I just want to be really make sure that I'm an advocate for, a good qualified buyer, that we have the solutions that can help them get into the house. So I feel very fortunate to be where I'm at.
That's awesome. That is really, really awesome. Is there anything else that people need to know about you and Central Bank that we haven't covered?
Yeah. So you just mentioned earlier, I mean, it kind of brought a lot to mind, is a homeowner. And I've seen this happen so many times where they're halfway through a transaction and they just, even though they've received disclosures, they don't fully understand what they're getting into. They get the home buying is emotional, and all of a sudden they have this shock, like, oh, I didn't realize I had to pay all this, or you talk about closing costs, you talk about the money that's in escrow, and they don't add it together. I take a great deal of time. To me, surprises although they can happen, and you know this well. I mean, there's just some things are outside of our control, but within our control, they should never happen. You should never find out after you enter a transaction, after you paid earnest deposit, after you paid for an appraisal, after you paid for home inspections, that, oops, I forgot to tell you this. So I spent a great deal of time in just really educating the home buyer, and they'll understand exactly what they're getting into. And so, they say every good person has their adversaries. To me, surprises are my adversary. I want to abolish them and never have them come along. And so I feel very fortunate in that sense that it just builds a lot of trust, and trust in the right way, because I over communicate. I always try to overestimate both on cost and interest rates. And I would say almost every single case, my buyer is pleasantly surprised. And we do have a very, not to toot my lender's horn, but our rates are very competitive. Our fees are on average probably $300 to $400 under the national average. So we're very competitive, but just we do things right as well.
That's huge. And I love what you said about not having surprises. You think of closing costs, for example. A lot of times buyers, they don't know what they don't know. It's their first experience. And I also think it's so important that we do our due diligence as mortgage professionals and real estate professionals to make sure that we are educating people. Because what I find is oftentimes, some of our particular young folks, they're reluctant to ask questions because they don't want to feel dumb, which they should. There's no dumb questions.
There's not.
You can't know something you've never learned about. It's your first time. Yeah, at some point we all had to learn, what 1 + 1 is. We did, we weren't born knowing these things. So I think it's really important that we take that lead and make sure they know all. Yeah, but how much money are you going to need up front? How much are your inspections going to cost you? What happens to that earnest money? By the way, you get it credited back to you as long as you don't do anything goofy. It's not exactly how the contract's written. It doesn't say don't do anything goofy, for the record. So there's lots of things they have to know. So I love that you come from that perspective of education and making sure that people, and things change too over time. Somebody might have been in their home 10 years, and you don't remember all the things that you went through 10 years ago. You might need to be reminded of some things. And it's just super important for people to know what they're getting into and making sure that they're protected.
Exactly. Yeah. And again, every market is different too. I mean, maybe things haven't changed in 10 years, but the market has changed. And there's inherent risk in the way you have to be competitive in today's market. And what does that look like? And some things you just can't predict, but you can make a very strong, educated guess on it. And to me, that's important. It's my story I always go to is I had a buyer who was going through a different lender, and they asked for a loan with $10,000 down. It was a first-time home buyer, kind of going back to the question, and that's exactly what another lender gave them. What they didn't give them was the idea if they put $200 extra into that transaction, which could have been a gift from a relative, it would have saved them something like $8,000 over the next 5 years alone.
Wow.
That to me is just ludicrous, and it's not fair for anyone. So I think it's important for someone to look at all scenarios out there. There's sometimes going to be a difference between a 20% down and a 25% down payment. Sometimes, and this sounds ironic, but you can get a better rate with a 10% or 5% down payment than you can a 20, which, no one wants to pay the mortgage insurance, but that scenario of the recast, you put a minimal amount down, you sell your house, you pay down the loan, you get to keep the better rate, better than what you may have been with, if you had put that 20% down. So
that's a big deal.
It is.
That's a really big deal. Yeah. All those different scenarios can make a big difference. At the end of the day, again, I love that we're talking about helping people build their wealth over time and keeping more money in their pockets, which is
absolutely
awesome. I love that. And just to share with you that what you just shared with me, when I hear things like that, it makes me angry So do you want to know what my dream superpower would be?
What's that?
My dream superpower is the magic um uh blank slap. I won't say the word. So so it would just be out of thin air. Somebody would just get, no, that's wrong.
Especially go through the phone and right.
Yeah, no, you did not just do that.
I know. So it's just amazing some of the things. I mean, there's just so many things that you could do smoke and mirrors, and it just frustrates me in this business. And so you know why that's why I really respect working with someone like yourself who is really a professional, because there's just a lot of agents that have a license and they have no experience. But I don't think many people understand that. And I will tell you, in this market particularly, professionals, full-time agents who know what they're doing are making all the difference in getting an offer accepted. All the difference.
Oh, it's huge. It's huge. And the other thing, Will, that is making me so angry, if I see one more crooked real estate photo, I'm gonna scream. I mean, here's the thing. Right now, any squirrel can get a nut. You can go hire Joe Schmo cut rate agent, and pay a really small fee, and that doesn't care, because they're getting their money up front from you anyway. They don't care. They don't care if they sell your house. Or there's some of them that are charging the full, charging the 6%, which is average. It's not set in stone, but it's average. That's what I charge for a listing. And they're still just doing the bare minimum. It's awful. It's awful. I was out, I showed a house to some clients of mine the other day, and this house, the buyer or the seller, beautiful job. I mean, you walk in, it's one of those, you walk in and it's immaculate. The home has been very well taken care of. Fantastic job on the seller's part, and their agent, by the way. But they were telling me they went to an open house. There was poop on the toilet.
No.
Yeah. How do you, first of all, you can't let your seller do that. And how do you, as an agent, I just don't know how you put your name to something like that. And I don't understand it. I just don't. I'm seeing so much of that right now, and it makes me angry for those sellers, because they don't know they don't know what their opportunity cost is that they're losing. They're losing opportunity because they hired somebody who's not professional, doesn't care about them, isn't doing, you still need to do all the things. The house still needs to look great. It still needs to be marketed right. It needs all those things, because you're still trying to attract the most number of buyers to that property so that seller can get the most equity out of their home. I mean, that's still what we're trying to do in most cases. So yeah, I could go on. That's my soapbox, but yeah.
Well, so true.
Research, people, hire an agent who cares about you and you can trust, please.
Absolutely. And I think some agents have this perception, which is so crazy, but home buyer or home sellers do as well, that, it's just stick it in the MLS and everyone will come and make multiple offers. And that's so untrue. There's so much work that happens behind the scenes. And I mean, it as an agent who represents a buyer, how that home is presented. And I think relationships, I have seen so many transactions I think blew up just because an agent was horrible to work with. It's just little things like that. I mean, if I'm a listing agent and I'm getting a buyer an offer, 2 offers, 4 offers, 5 offers that are all similar, and an agent is just, for lack of a better word, being a jerk, it's not the offer that's going to be accepted. You know that well. There's professionalism that has to come along in this business when you're representing a client. And I don't think people realize how much a difference a good agent makes, whether you're selling a house or you're buying.
Yeah. And I think there's a little bit of a dichotomy there, because on the one hand, there's things that a lot of times that, I might be doing for my seller, for my buyer, that they have no idea about. And I don't want them to know, because they don't, unless they need to know, I'm not going to tell them anything that's going to cause them stress.
Yeah.
If it's something that they don't need to know, it's not, it's not germane to them. It's just me having to deal with somebody else trying to cause drama. And I'm not going to tell them. I had a situation, I had a listing. It was when we were first went under lockdown last year. And the agent I was dealing with, I mean, I don't know what she was about to blow up the deal because of how she was communicating with her client. She was just very over the top dramatic. And I was just on the phone having basically counseling sessions with her. And she even made the comment that I was counseling her. I was like, yeah, you're welcome. I'll send you a bill. I mean, but fortunately we got to the closing table, but I mean, honestly, yeah, she could have easily blown it all up for no good reason.
Gosh, yeah.
Mhm.
It's a stressful time buying a home. And, if there are things that we cannot add to the plate, it's important. You need to know when to share and when not to share. So, but the beauty
Mhm.
of it is getting to the table, and there's nothing more rewarding than that.
Absolutely. Getting people happy and getting them onto their next best stuff in life. That's what I live for. It's the
Yeah,
most exciting
exactly.
part. Yep.
Yep.
It doesn't, and honestly, and it doesn't matter, I have some clients I'm working with, and it doesn't matter what price point they're in, at least as far as I'm concerned. I don't care if you're buying $100,000 property or a $500,000 property. You deserve to be treated like gold, and you deserve to have somebody have your back. And to me, that's what it's about. So
Absolutely. I mean, I think your professional and fiduciary obligation to treat everyone
it
the
is.
same. So, yeah.
Well, it's in our realtor code of ethics. We are
It's
fiduciaries.
true. I'm not sure we all read it, or even the mortgage professionals as well. So, but
Yeah.
yes, should be very paramount to the way we do our job. So,
Yeah, it's actually really beautifully written. I mean, it brings a tear to my eye. I couldn't recite it to you, but when I read it, it's like, well, that's just beautiful.
we need to get a frame for you.
Yeah, I should. I'll put it in my office and read it. So, well, thank you so much for
It's been a
coming.
pleasure.
Yeah, this has been great. I love you came prepared with great information and it's super helpful. I think people are going to get a lot out of it. So this has been really, really awesome. And hopefully one of these days soon we'll get to do a deal together.
I will look forward to that. That would
Yeah,
be fun.
I would love that.
All right. Well,
Well,
thank you so much, Angie. I appreciate it.
you're so welcome. And this has been Angie Harness with Keller Williams. And if you thinking about making a move, I'd love to just offer you a little consultation and just have a fun chat.